The AI trade just received almost everything bulls said it needed, and the market still sold it. Producer inflation fell 0.3% in June. TSMC reported a 77.4% jump in quarterly profit, and management guided to even higher third-quarter revenue. Yet the semiconductor ETF SOXX dropped about 4.5%, AMD fell more than 5%, Nvidia lost about 2.4%, TSM fell about 2.3%, and the Nasdaq finished down roughly 1.5%. The previous question was whether cooler producer inflation could confirm the rally. This session delivered the answer, because when strong macro and earnings news cannot lift price, the market may be exposing a problem in expectations, valuation, and positioning rather than a collapse in the underlying business. TSMC's numbers did not describe an AI demand bust. Revenue reached $40.2 billion. Advanced technologies represented 77% of wafer revenue, and the company said leading-edge demand should continue supporting the next quarter. Its third-quarter revenue guidance of $44.6 to $45.8 billion was above the second quarter, while 2-nanometer production was already contributing to wafer revenue and beginning a steep ramp. The weakness appeared in the price response, which does not prove investors have abandoned AI, but does show that excellent fundamentals were already competing against an exceptionally high bar. The second layer is liquidity. Cooling producer prices looked supportive, but the report was heavily influenced by a 6.4% monthly decline in energy prices, while final demand prices were still 5.5% higher than a year earlier, and the core measure excluding food, energy and trade services rose 5.1% year over year. Retail sales also rose 0.2% in June, and claims data remained firm, giving the market little reason to price an immediate economic slowdown or rapid monetary easing. Treasury yields and the dollar moved modestly higher, so the financial conditions surrounding long-duration growth stocks did not deliver the clean relief that the inflation headline seemed to promise. This is where positioning matters. When a trade becomes crowded, investors do not need terrible news to sell. They only need news that is not strong enough to justify the expectations already embedded in price. TSMC confirmed that AI demand remains powerful, but the market may have been looking for an even larger surprise, cleaner margin expansion, or a stronger reason for rates to fall before adding more exposure at elevated valuations. The sell-off therefore looks more like a valuation and positioning warning than verified evidence that the AI spending cycle has broken, and that distinction matters because a crowded trade reset and a fundamental demand collapse require completely different responses. Now the confirmation test is simple. If semiconductors keep underperforming while Treasury yields and the dollar remain firm, the market is confirming that liquidity and positioning are overpowering the earnings story, especially if rebound attempts fail near Thursday's breakdown levels. If chip stocks reclaim the sell-off and rates soften after housing data, industrial production, and consumer inflation expectations, this move may prove to be a temporary flush rather than a deeper repricing. One session cannot settle the entire AI thesis, but it can expose how fragile a trade becomes when good news is no longer enough, and that is the calm metric investors should watch next.